Title: Governing Success: The Impact of Corporate Governance on Publicly Traded Companies. Introduction. In the intricate realm of corporate dynamics, the concept of corporate governance stands as a sentinel, shaping the course of publicly traded companies and influencing their performance. Corporate governance, often hailed as the blueprint for organizational conduct, is a multifaceted framework encompassing structures, processes, and policies that guide decision-making and ensure accountability. This article delves into the profound impact that corporate governance exerts on the performance of publicly traded companies, unraveling the intricate threads that bind governance practices to long-term success. Defining corporate governance. At its core, corporate governance is a set of principles and practices designed to ensure transparency, fairness, and accountability in the management of a company. These principles are instrumental in aligning the interests of various stakeholders, shareholders, executives, employees, and the broader community. The bedrock of effective corporate governance lies in mechanisms that mitigate conflicts of interest, foster ethical conduct, and promote strategic decision-making. The ripple effect on performance. The impact of corporate governance on the performance of publicly traded companies is profound and far-reaching. Robust governance structures are associated with higher levels of investor trust, lower capital costs, and enhanced access to capital. By instilling confidence among investors and stakeholders, companies with strong corporate governance frameworks are better positioned to weather market uncertainties and attract long-term investments. Consider the contrasting scenarios of Company A and Company B, both operating in the same industry with similar financial metrics. However, Company A boasts a transparent governance structure, an independent board of directors, and stringent ethical standards, while Company B lacks these governance pillars. Over time, investors may gravitate towards Company A, perceiving it as a safer and more reliable investment due to its commitment to sound corporate governance practices. The role of the board of directors. A linchpin of corporate governance, the board of directors plays a pivotal role in overseeing company strategy, mitigating risk, and safeguarding shareholder interests. An independent and diverse board can act as a bulwark against managerial excesses, ensuring that decisions align with the company's long-term objectives rather than short-term gains. Companies with effective boards tend to exhibit more prudent risk management and strategic planning, contributing to sustained performance. For instance, consider a publicly traded company facing a critical strategic decision, such as a merger or acquisition. A board comprised of independent directors with diverse expertise is more likely to scrutinize the proposal rigorously, weighing potential risks and benefits. This thoughtful governance approach can prevent hasty decisions driven solely by short-term gains, fostering a strategic vision that enhances the company's overall performance. Transparency and accountability. Transparency is a cornerstone of effective corporate governance. Companies that prioritize open communication, disclose financial information accurately, and maintain clear lines of accountability are viewed favorably by investors. Transparency builds trust, offering stakeholders a comprehensive view of the company's operations, financial health, and risk exposure. In contrast, companies with opaque governance structures may face skepticism from investors, leading to higher capital costs and potential disinvestment. The Enron scandal in the early 2000s serves as a stark illustration of the consequences of weak corporate governance. Enron's lack of transparency and accountability resulted in a catastrophic collapse. A eroding shareholder value and triggering widespread regulatory reforms aimed at bolstering corporate governance standards. Executive compensation and performance alignment. The alignment of executive compensation with company performance is a critical aspect of corporate governance. Companies that link executive pay to long-term performance metrics, rather than short-term financial targets, foster a culture of accountability and strategic thinking. Such compensation structures incentivize executives to prioritize sustainable growth and value creation. Consider two companies in the same sector, one with a performance-based compensation model and the other with a structure that rewards short-term gains. Over time, the former is likely to exhibit more consistent and sustainable performance. As executives are motivated to make decisions that contribute to the company's long-term success rather than focusing on quarterly results to maximize personal bonuses. Regulatory compliance and ethical conduct. Corporate governance extends beyond voluntary best practices. It encompasses compliance with regulatory frameworks and ethical standards. Companies that uphold the highest ethical standards and comply with relevant laws and regulations are better equipped to navigate challenges and build enduring relationships with stakeholders. Ethical conduct is not just a moral imperative, it is a strategic advantage that contributes to a company's reputation and, consequently, its performance. Consider a publicly traded company that embraces ethical conduct, refraining from engaging in practices that may compromise integrity. Such a company is likely to attract socially responsible investors and maintain a positive public image, contributing to enhanced brand value and stakeholder trust. On the other hand, companies embroiled in ethical controversies face reputational damage that can have lasting implications on their performance. Global perspectives on corporate governance. The impact of corporate governance on publicly traded companies extends beyond national borders. In an increasingly interconnected global economy, companies that adhere to robust governance principles are better positioned to attract international investments and navigate the complexities of diverse regulatory environments. International investors often prioritize companies with transparent governance structures, viewing them as safer and more reliable investments. For instance, a multinational corporation listed on multiple stock exchanges must navigate the regulatory landscapes of various countries. Companies with strong corporate governance practices can adapt more seamlessly to these diverse regulatory requirements, instilling confidence in investors across different regions. Conclusion: as we navigate the intricate terrain of corporate governance and its impact on publicly traded companies, it becomes evident that governance is not merely a compliance exercise, it is a catalyst for sustainable success. Effective corporate governance enhances investor confidence, mitigates risks, and fosters a culture of accountability and transparency. Publicly traded companies that prioritize governance as a strategic imperative are not only more resilient in the face of challenges, but also better equipped to capitalize on opportunities and deliver enduring value to shareholders and stakeholders alike. It is a journey towards excellence, one where governance serves as the guiding force propelling companies towards sustained performance and success in the ever-evolving landscape of corporate dynamics.